Hello and welcome back to Unblocking the Chain. I'm Ash Cooper, and today we're deep diving into the world of investment management in the digital asset space. Talking to the CIO of JellyC Investment Management, Michael Prendiville, Michael Critter Prendiville, and Drew Bradford, the chairman of JellyC. It might be the right time to think about investing in digital assets and why you might consider JellyC as that vehicle. Michael, let's kick things off. Why are you called Critter?
Wow, Coops, that's a good question. I'm the youngest of 11 children, and growing up, I was called the little critter. So it just stuck, and I've been stuck with it for the rest of my life.
Do the other 10 siblings have nicknames as well?
They all do.
What are some great nicknames?
So we've got up the top, we've got Bear and Crabs and Dog. And there's a hell of a lot of other ones to go through as well. Actually, I used to play footy down at Uni Footy Club, and most of the people down there didn't know my actual name. They only knew me as Critter, a little bit like Madonna or Sting.
Or the artist formerly known as Prince.
Yeah.
So let's start off with you as the CIO of JellyC Investment Management. Do you want to run us through why there's three funds, what the three funds do, and how you thought about setting those up?
Sure. I mean, just understand we have three funds, and all three of those funds were set up as vehicles for yourself and myself and Drew to invest in. Okay, so these are the funds that we actually want to put our money in. We are the three biggest unit holders in all three of these funds. Okay, so that's an important thing for people to know, that we are aligned with the strategies of our funds. So in saying all that, the first fund is the Blue Bottle Multi-Strategy Fund. It was the first fund that we launched back in November 2021. We launched at the high. Bitcoin was up around 64,000 at that time. And this fund allows us to be able to invest in seed projects. So there's a VC component, which is a liquid, and then we also have liquid strategies, such as a long-only staking, arbitrage basis, and on the odd occasion, we also go farming for airdrops. Okay, so it's pretty much however we could generate alpha, that's what we were looking to do. Okay, and that fund has done well from an adjusted NAV, so revaluing everything live, it sits around 1.4 at the moment. It started at 1. Okay, so relative to the performance of Bitcoin when that launched at the same time as we launched, we've outperformed the market. So
okay, so that's
the first fund.
That's the multi-strategy fund.
Yep.
Let's talk about the digital infrastructure fund, what the name means, and why that's a interesting strategy by itself.
Yeah, so during 2022, when the crypto market had a severe pullback, we looked inward and we saw what strategies were working well. And the long-only staking and running nodes within the Blue Bottle Fund, within the multi-strategy fund, was working well. So we took that strategy out, and we thought there was no capacity constraints on this particular strategy. So we took it out, and in July 2023, we launched the infrastructure fund. And since that time, the fund has performed very well. At one point, I think we were number 2 in Australia in terms of performance of all the funds in Australia. I think that was sometime at the start of this year. At the moment it sits around 73% up and launched July 2023.
Yep, that's great. And so could we just talk a little bit about the networks and why you think they're important to invest in and selecting those networks?
Yeah, so the networks, consider it like this. You have an iPhone and you pay a certain amount for the iPhone, and on that iPhone you have your apps. Okay, so the networks are like the iPhone. And then the decentralized apps are like the apps. Okay, so the networks basically allow every transaction to go through. And every time a transaction goes through, a fee is paid. Okay, so you have like a utility in the network. And we believe the network is where it doesn't matter whether it's a meme coin, it doesn't matter whether it's DeFi, it doesn't matter whether it's, gaming, and there's a million other different utilities and sectors which, can operate on a network. We believe that if you're invested in the network, long term, there'll be lots of utility, and that's where there'll be a lot of growth.
Yeah, and the profile of the performance of that is both growth and a dividend or coupon of sorts.
Yeah, so we don't pay out any dividend, but what happens is a compounding yield goes back into the growth of the fund. So over time, we would expect this to outperform Bitcoin, outperform Ethereum, and in, for instance, 2030, once every country has brought in regulations for crypto, and you have tokenization movement going through, and you have every single transaction going through the blockchain, whether it be payments for your coffees or goods and services in general, or the larger transactions like the real world assets, which are backed by a tokenization movement. We believe every single transaction will go through the blockchain, and the infrastructure funds or the infrastructure networks will receive a lot of fees as a result of it. So think of Telstra, think of Optus, and how every single phone call goes through those networks and they generate a small fee. It's exactly the same. So we are investing in what is the infrastructure of the space.
And managing that and thinking about investment in that portfolio, you're trying to pick the networks that are going to have the most transactions or the most stuff is going to be built on.
That's right. We have it weighted in a way that is basically identifying, the best utility. Okay, so at the moment we have the strongest holding in our fund is on Ethereum. Okay, and that's because Ethereum has pretty much the most traffic, the most adoption, the most, from a balance sheet perspective, the most assets. From a TVL perspective, total value locked perspective, it has, a real dominant market share. But we also invest in other networks like Solana. We're investing in an AI network in Near. We're just invested in the open network, so TON. And on that front, they have a couple of games which are just about to launch an airdrop. One of them is Hamster Combat, which actually has 250 million users on it. Okay, so think about how they can possibly monetize that adoption.
Who knew? 250,000
I mean, that's a nice
users.
That's a great customer
250
base.
million.
250 million
250
users playing
million users
Hamster
playing. Yeah, so
Combat.
I'm on it. My son's on it. He's got 50. What's he got? He's got 50 million coins. I'm on it. I've got 5.5 million coins. I'm just hoping to get a small airdrop PA from it. But they're expecting that this could be bigger than Uniswap. Uniswap had a airdrop which was around about $6.7 billion worth. They're expecting this could be even bigger. And so what that means to a network like TON, imagine another, let's say, 7 to 10 billion worth of TVL, so the market capitalization of that airdrop going on to TON. Okay, so that extra TVL, that allows for forward earnings in terms of the transactions that turn over. So the more money people have, the more they turn over. Okay, the more they turn over, the more the fees go into the network. Okay, so you see with a bigger amount of TVL, you're expecting more fees or revenues to go into the network.
Yep. So, I mean, simply you're just looking for more users. As you get more TVL, the users pay more, essentially. Revenues rise.
More turnover, that's right, more fees, etc.
Great. So that's the Digital Infrastructure Fund. The soft launch of the Alternative Income Fund. Can you just talk us through that strategy? And I know that's a market neutral strategy, so less, dependent on the overall market.
Yeah, so what we wanted is, let's say end of 2026, start of 2027, if crypto has gone from a market cap of, let's say, what is it, 2.15 trillion, if it goes from that point to, let's say, 20 trillion, okay, and we want to take some money off, we need to have a strategy in play which has a good track record, which people can invest in. Okay, so we are launching the Alternative Income Fund right now for that purpose. We don't think that, we still think that people should be fully vested in the space, but 2 to 3 years down the track, when you want to take some money off, this is a good strategy to be able to park your money. Okay, so this is the reason that we're launching it. Why haven't we launched this fund earlier? It's because the technology has not been in place for us to be able to mitigate counterparty risk. Okay, to run this strategy prior to this point, we would have had to have our money parked on all of these centralized exchanges, like, for instance, Binance or Kraken or Gemini or, Bullish, for instance. That sort of leaves us subject to a FTX or a Celsius or a Voyager type scenario. Okay, so we haven't been willing to leave our money parked on the exchanges. Now we have new technology in Fireblocks off exchange, where we can keep the money stored in a safe vault, in custody, and we can use that collateral to trade with a number of different exchanges. Okay, so the technology has improved to the point where we now feel comfortable that we can launch this fund and we can have it running in the future without any hiccups.
Yeah, and so just digging into the strategy of that fund, what sort of target yield are you looking at, and how are you making that yield through the different strategies?
12 to 15% per annum target yield. We're paying semi-annual coupons, so we pay that yield out to investors. We've got 5 strategies. One of the strategies is basis trading. Another strategy is arbitrage. We're looking to leverage. There's a lot of goodness in what we're looking to do.
Yeah, that's great. So it's not relying on one strategy. We've
Not
got a
relying on
diverse
one
strategy within the strategy.
That's right.
Very interesting. I'm going to come back to the counterparty risk and custody later, because I think it's such an important and quite a point of differentiation that I think we really need to hit home on. But this is where I'm going to bring Drew in, big picture, how we think about the cycles. Why is it a good time to think about investing in digital assets now? I mean, you've done a lot of work on the liquidity cycles and various asset classes.
Oh, look, absolutely, Ash. And, you've got to look, let's go back just to last Friday night. You had the Fed, you had Jackson Hole Conference, and Jerome Powell came out and said, now is the time for the US to start easing monetary policy. If you take that and stand back, when central banks tighten monetary policy, as we have seen around the world, basically in a reaction to the inflation that was caused by all the cash that hit the system over COVID and went into everyone's bank accounts, which they promptly went out and spent, we've had a couple of years of all the central banks around the world tightening monetary policy. The whole idea is to take money out of the system, which impacts the price of assets. We are now seeing an environment where it's not just the Fed, you've seen the ECB, China, all lowering interest rates and injecting money back into the system. So that will create a much more friendlier environment for assets in general. But I think for a number of reasons, it'll impact digital assets with a greater degree of oomph as that money flows in. And the reason I think that is twofold. Firstly, there's 21 million Bitcoins. If you look at the US, even the Australian dollar, the Australians, since 1960, we print 9% more Aussie dollars every year. That's how fast M2 grows. So there is more and more Aussie dollars. There's only ever 21 million Bitcoins. So as currencies become more plentiful, digital assets like Bitcoin become just naturally worth more. And I think that another thing that is really going to start impacting on the prices of digital assets is the fact that AI has become a thing. And if you add a digital proportion, as Critter touched on before, whether it be 2 or 4% to a traditional portfolio of stocks and bonds, that portfolio will outperform with digital assets in terms of both Sharpe ratio, Sortino ratio, your overall risk. You will outperform. More and more asset managers are going to use AI to help them shape their asset portfolios. So the AI will tell them to buy digital assets. So right now you've got a combination of monetary policy becoming looser, so more liquidity in the system, which will push assets up. And you're seeing asset managers starting to use artificial intelligence to help them in their portfolio selection. And that will tell them to buy the limited assets, digital assets versus your general traditional finance assets. So I think a combination of both those things over the next 24 months, especially as we go into global regulation and we get more normality around the digital space, that those three things will form, I think, a big tidal wave into the space.
Can we just go, because I think it's something that people struggle to understand. When you said 9% per year of additional Aussie dollars into the system, what does that mean and what's the effect of that?
What does it mean is there's just more Aussie dollars. There's more US dollars. You look at the number of things that, so if you've got $1,000 at the beginning of the year, at the end of the year, you've got 1,090. So people will have extra money. They will buy things with it. So that just means the value of assets that aren't increasing in volume, in reality, go up. You know, if you give this the classic, and this is Kamala Harris is getting challenged on this. She wants to give all first homeowners $25,000 if they go out and buy a house. All that means is all the houses go up by $25,000 if you give everyone $25,000 to buy a house. If you give people more money, the value of things will go up by the amount of more money.
So the question then is it the asset going up?
No,
or is it
it's not. It's actually
denominator
the dollar,
going
it's the
up?
dollar going down because there's more of them.
Yeah.
So my fundamental view is that you're by debasing the currency, you're making it worth less, not the actual asset. And that could be a house price or a Bitcoin. But, you know, that's why they're going up. It's the value of the dollar going down.
Should we be getting paid in Bitcoin, Drew? Yeah, our salaries in Bitcoin. Can we do that?
Yeah, are you paying salaries?
Yeah, let me know when you start.
Let me know when you start.
That distribution starts.
Hey, come on, you guys.
No, that's interesting. And again, I think that probably reverts back to 21 million fixed. Almost everything else, supply can be turned on if need be. And it's probably the argument.
And it does. It does. And there's a whole reason why you've got to think that monetary tap is going to get turned on. If you're a politician, the easiest way to keep people happy anywhere in the world is to spend more money and give your voting people more money. You're seeing this in the US election now. You see it all over the world. Every politician's coming out promising to spend more. There's not a politician in the world promising, I'm going to take money away from you and promising to spend less. No one wins elections with, hey, I'm going to put up tax by 50% to repay the government's debt. It just doesn't happen. You don't get voted in.
And I mean, that brings the question, if they keep on promising their citizens money, how does this debt cycle ever reverse, stop, get fixed? Don't you just continue to have this debasement and essentially fixed supply of assets is the ultimate winner?
Oh, I believe that 100%. And you can see whether we're in Australia or the US, it's a slow burn. And you've only got to go to Argentina or Zimbabwe to see when it gets out of hand really, really quickly. The Argentinian peso is trading at 900 to the US dollar. 20 years ago, it was 1 for 1.
Yeah.
So it's gone from 1 to 900 because governments just promise too much. So you can see it get out of hand. But at 9% growth per annum, whether you're in Australia or the US, that M2 is growing at, it's happening. It's just slowly.
Yeah. So, I mean, a compounding, what is that? 8 years and your money's halved, right?
Yeah. And that's why a house price doubles every 8 years or so. Think about it. The house there's just more Aussie dollars to buy the house.
Yeah. So fixed supply. So, Critter, going on to then central bank policies on the macro side, obviously the technical side of investment management and digital asset space. Let's talk about it, 3 months, 6 months, a year forward. What are you thinking in how to allocate into the digital asset space across the three funds?
I still believe that we need to be fully involved in the space. So we need to be long the space. There's a hell of a lot more that's got to play out. As I said, each country needs to regulate on the crypto side. There needs to be the tokenization movement. There needs to be pretty much the point where every single transaction is going through the blockchain, and that is feeding through to the valuation of the networks. Okay, so whilst we're waiting for that to play out, we have to be fully invested from our perspective. In saying all that, in the Blue Bottle Multi-Strategy Fund, we will take the opportunity to hedge when we think things are, for instance, overblown. For the punters out there that are looking for an indicator, when the fear and greed index gets above 90, we're happy to take some of our exposure off, and we'll sell some futures at that point and lock in the premium. Okay, on vice versa, if the fear and greed index were to go under 20 or under 10, we would be taking that back in. Just recently, Bitcoin went down to 50,000, Ethereum went down to 2,200. We were short future, we were partially hedged. We took that back. Okay, so now we're fully, fully long again, looking to ride that up. So in answer to your question, next 3, 6, 12, 24 months, we are happy to be fully invested. We're happy to, ride this, ride the wave and continue riding it up. I guess our thesis is, whilst Ethereum may be a little bit depressed at the moment, our thesis is Ethereum will hit 10,000 by 2030. Okay, so for Bitcoin, you can say that, Bitcoin should be above 200,000 at some point in the future.
Yep. So what I'm hearing is tailwind from the macro, liquidity, interest rate cuts, however that liquidity comes, with huge efficiency gains in the technology that it's providing, and your job is to pick the best examples of that, either in an early stage or a network function.
Yeah.
The ones that are going to have the biggest adoption.
Yeah. So I mean, we talk about macro, and then we talk about the overall rising tide of the crypto space. So the macro perspective can go up and down, and yes, as Drew mentioned earlier, interest rates are going to come off, and there's going to be more liquidity in the system, and it's very unlikely that that's going to change at any point, and so that will be positive for crypto, but overall, crypto will will continue to gather momentum, irrespective of what happens on the macro side. Okay, there'll be more and more transactions that go through the blockchain, and this will just underpin the value of the networks and the bigger, for instance, decentralized apps like Aave, Uniswap, etc. They'll underpin this going forward. Okay, so we're confident that to buy on every significant dip, we're happy to buy into that dip.
Yeah, so we've got the, again, combination. So you're now talking about the S-curve or Metcalfe law of technology adoption will be the main driver over time with the liquidity cycles, playing their secular game. The question always get asked, and speaking to sort of investors, probably more on the institutional side, is how do you think about evaluating or building a valuation model around a network or a cryptocurrency?
Yeah, so that's a difficult question to answer, and it's probably valuing a digital asset, which is not a real world asset, is probably the hardest thing to be able to explain, and it's the one reason why we're not getting more institutional investment at this point in time. Okay, aside from regulation, how do we look at it? And I'll try and simplify it for all of the listeners out there. But we look at it for instance, like an equity. Okay, so an equity, you'll look at the P&L, the profit and loss statement. You look at the balance sheet, and you look at the growth metrics of that particular equity. Okay, from a P&L perspective, we're looking at the profit or the revenues, the fees that are coming in from the network. Okay, from an expenses perspective, we're looking at the costs of the network. We're also looking at the rewards or emissions that are paid out. They're part of the expenses of the network. Okay, so between those things, you can sort of generate what would be quite a decent P&L. On the balance sheet, okay, we're looking at what assets does the treasury of that particular network hold. Also, what is the TVL, so total value locked, of all the assets that are involved in that network. And the reason we look at the TVL is because it gives us a good sense of what the forward earnings will be. The bigger the TVL, the more that we're likely to get turnover, the more likely we are to get fees coming through the network. Okay, and then finally we look at the growth metrics. So growth metrics can be adoption. We look at all sorts of things for adoption metrics, but one of them would be daily active users or monthly active users. Okay, so we talked about the TON network and how they had 250 million users. Let's say, for instance, their daily active users, that would be around about 50 million. Okay, 50 million daily active users is significant. That's more than Ethereum. That's more than Solana. That's more than a lot of the networks. Okay, so that is significant in terms of valuing that particular game or that particular decentralized app.
I just think about it off the top of my head against a traditional world. Any company with a user base of 250 million people.
I think there's 900 million that use Telegram.
Yeah, that's so 950 million in Telegram. But I was just talking about
Your hamsters.
Hamster combat. Sorry.
Yeah, so any company in the world, let's call it Telegram messaging app, 900, let's call it 1 billion people. Yeah. That's an amazing business.
Yeah.
Amazing number of clients.
Unbelievable.
You make a small amount of revenue off each client. Do you think the blockchain digital asset world, to me, that sounds like a very clear sort of an easier way to understand. They're still businesses. They still make revenue. They still have balance sheets and thinking about how to grow that customer base. I think that's a very, succinct way to sort of talk about it.
Yeah. So the important thing is for people to be able to feel like there is a valuation metric. So it's not, for instance, it can't just go to zero. If it's a network which is producing revenues and is profitable and is, for instance, deflationary, okay, like BNB is, like, for instance, Tron is, like PancakeSwap is, like Ethereum was, it's turned slightly inflationary at the moment, about a 0.5% inflation. Bitcoin is slightly inflationary.
Can we just talk quickly about the inflation and deflation of tokens and what that means and why it happens?
So it's a good indicator of whether a network is profitable or not. Okay, so if it's a deflationary network, okay, it means that, for instance, there is utility, and for instance, they're using the utility it comes in terms of revenues, okay, and some of those revenues can be used to either burn the token, okay, so there's less supply of tokens out there, for
Is
instance.
that like share buybacks?
Like share buybacks, it's a good way of putting it. And for instance, there's less supply, there's more demand coming through. The pressure on the token is to appreciate.
And the inflationary side is issuing more to incentivize more. Is that right?
That's right. So generally what you'll do is you'll look at what is the real rate of return. Okay, so you'll have a yield from the emissions, from the rewards that are paid. Okay, and then you'll look at whether it's inflationary or deflationary after that.
Yeah, great. I mean, I think that clears it up a lot. I think there's a very, large misconception about how, JellyC think about valuing tokens. It's not just a finger in the air. There is a methodology to it,
Yeah.
and a framework across all the funds.
Yeah, so the bigger asset managers like BlackRock and Fidelity, etc., they have begun to put out research which has is giving a light framework on where they see value in, for instance, assets like Bitcoin and Ethereum, okay, which are the two ETF-based cryptocurrencies. Okay, so for instance, we have put out a research piece that says we see value in Bitcoin around 30 to 35,000 against the US. Okay, and that's based off our analysis, our P&L, our balance sheet, and growth metrics. Ethereum, around about 2,000 against the US.
Yeah, thanks, Gret. So going on to Drew, how do you think about an allocation? You've got a portfolio of assets, your financial planner, your wealth manager, your superannuation. How would you think about percentage allocation and how would you think about allocating across the different JellyC funds?
Okay, I'll do the first one. How do I think about the allocation? I personally look at Bitcoin as a much better version of gold. Gold has been a store of wealth for human beings for millennia, but it's actually quite clunky. You've got to carry it around. It's heavy. And it's not divisible. There's a whole lot of things why it makes it a lousy store of wealth. Whereas Bitcoin, there's 21 million of them, divisible down to 8 decimal places. You can send it anywhere. So if I look at, for me, from a personal portfolio, how much would I allocate to gold as a store of wealth versus how much would I allocate to Bitcoin? So I would just take gold out. And traditionally people look at, if you look at a bog standard asset manager, on a balanced portfolio, there's 5% that goes to gold, commodities and stuff like that. So I would go, if I'm standing back and wanted a very balanced portfolio, I would do 3 to 5. And I think, Chris, you mentioned earlier, 2 to 4 in...
a little bit conservative, Drew.
A little bit conservative. I'm a little bit longer than that because I think I'm very positive on the space.
Am I hearing irresponsibly long?
I did hear Drew say something about not diversifying in one of his podcasts, and I took that on board.
Well, if you, there's some great stats. If you invested just in the stock market as a whole, if you rebalance your portfolio, and like a lot of asset managers do, if something goes up by more than a certain amount, they sell it and they buy stuff if it goes down by more than a certain amount, you're much better off staying with the ones that are going up and getting rid of the ones that are going down over time.
Yeah, so we've done quite a bit of analysis on portfolio rebalancing. And we began doing it for a small section within the Blue Bottle Fund, and then ran the figures and kept running the figures and back tested. and came to the conclusion exactly what Drew said. You should not rebalance a portfolio that has in an asset class that has a volatility of 70%. You're much better off getting rid of the losers and sticking with the winners and not rebalancing. Okay, there will be a point where volatility comes down below, in our space, comes down below, let's say, 15%. Okay, and that may be in the 2030s. At that point, that is when you want to turn on that rebalancing portfolio.
I agree 100%. I think we're 5 odd years away from that, and there's a bunch of reasons why I think 2030 is going to be, and we'll have sort of full adoption in the way that the regulations around the world will bring in all the institutional investors, and they will have made a decision: are they in or they're not? What their portfolio is going to be. So I think we'll see volatility slowly go down from the current 70-ish% to being the same as other asset classes in that 5, 6, 7 years time. So then you would go down to your 2 at 4%.
Will there be a flippening where, for instance, you get traditional fiat currencies more volatile than, for instance, some of the blue chips on the crypto space, like Bitcoin?
Absolutely. I think you will see emerging markets currencies. We touched on Argentina and the Argentinian peso. You've only got to look what's happened in Turkey, Argentina, Zimbabwe, right? There's plenty of currencies that trade at much higher volatility than Bitcoin.
Yeah.
Drew, just coming back to gold versus Bitcoin, we've all had debates with gold people, Bitcoin versus gold. Do you think the gold and Bitcoin people are coming, with the same sort of thought process or macro process and just deploying it through different assets?
Yeah, I do. You hold gold as a store of wealth. It doesn't do anything else. It actually costs you to hold gold. You don't earn any interest off it.
It's inflationary as well.
And people are still digging it out of the ground, right?
Yeah,
so it is inflationary. So if you look at gold, I stand back and look at gold. The total supply of gold is worth about $14 trillion at the moment. So for me, in my head, Bitcoin at 1.2 trillion, wherever we are, it's got 10x, and maybe it doesn't go to being equal to gold, but it's got to go to being equal half of gold. So in my head, I've got this fundamental view that 300,000-400,000 US will be over time where Bitcoin balances out, and you people will diversify out of gold and into Bitcoin as a store of wealth. Of course, for every reason, portability, accountability, all of that, all the reasons why what money exists, Bitcoin does a better job of being money than gold does.
Yeah, so you got the combination of money and store of value.
Yep.
I think the other thing that people...
And unit of account.
Unit of account, yeah. I think the other thing that there's a lot of discussion going around, obviously we've seen a lot of chat from, corporate balance sheets are starting to adopt it, Michael Saylor being, very proficient at that, is when do the sovereigns start adopting this as a strategic reserve? I was looking at the numbers in the US the other day. It's the only asset class really that outperforms their speed of debt growth.
Look, this is, Donald Trump's talked about this, that he would keep, if he becomes president, they're sitting on 200,000 Bitcoin, proceeds of crime from Silk Road, a few other things. They would keep that as a strategic reserve. And if you look at that, it makes a ton of sense for a bunch of governments, maybe as we touched on the emerging markets governments, where you're better off keeping a digital asset that is a fixed supply as your reserves, as opposed to what they're doing at the moment. They will be in better shape over time.
El Salvador's been buying 1 Bitcoin a day over the last few months, let's put it that way.
Because a lot of these countries too are US dollar indebted, right? So that's causing, outside the currency move, the level of debt and the increase in, interest that they owe to the US is high.
That is a big problem for a number of emerging market currencies. No one wants to have the asset, as in an Argentinian asset or an El Salvadorian asset. So these companies basically have to borrow in US dollars. They end up with US dollar debt and local currency income, and they get crushed. And the US dollar has been relatively strong over the last little while they've had higher interest rates.
So we haven't even touched on I guess the next move for Bitcoin, which is using the market capitalization of Bitcoin, close to, let's say, 1.3 trillion at the moment, and using that ability to be able to finance, projects. So what we're talking about is layer 2 Bitcoin, a layer 2, so a DeFi layer. And being able to use that to finance emerging market countries, that has the potential to sort of take us into an absolute new category of market capitalization for Bitcoin.
So let's just break that down very quickly. So you're talking about sovereign financing or leveraging off their Bitcoin, but that could be sovereign.
It could just be anyone that holds Bitcoin, getting a yield on Bitcoin, so lending out their Bitcoin. So, at the moment, it is only being done on a very, very small basis. Yep. Okay, but you can imagine close to 1.3 trillion worth of market cap in Bitcoin, and for instance, a good percentage of that being able to be lent out and earn a yield on. Okay, and that has got scope for huge additional valuations and users. That's right.
Yeah, interesting. So the final question, and this is one that it doesn't matter who you go and see: family offices, high net worth institutions, super funds. We've had some incidents in the digital asset space, which has caused assets to get locked up, potentially never to be returned. It's about custody. It's about not losing your assets. I think the volatility people are waking up to, volatility is coming down slowly. Losing someone's assets or getting them locked up for a long time is career ending, right? So can we just delve into how JellyC, protects investors' assets, because it is the number one fear of anyone that's advising in the investment space.
Yeah. So let's talk about custody for a second. JellyC has a self-custodial software in that it uses Fireblocks third-party custodial software. What that allows us to do is to have an institutional, I often say military-grade technology, which allows us to store our digital assets. Every time a transaction is done, there has to be multiple people signing that transaction. Okay, so I just want to reiterate that the avenues for fraud or theft are minuscule when you have an institutional grade setup. We also have Zodia Custody, which is our custodial solution, who obviously is another good solution. We have two, so we diversify the risk.
So just run us through, when you say 3 people, what does that mean?
Okay, so for instance, if we want to convert, let's say USDT, so Tether, into Bitcoin, to do that transaction, for instance, through a decentralized app like Uniswap, we will have to have 3 people sign off on that transaction. That means that we can't move the Tether without everyone, like authorised people within our institution, knowing what's going on.
So 3 people, just at JellyC, just to clarify, in different locations on different phones, have to verify that this is okay.
That's exactly right.
So if someone stole your phone, and specifically,
that should have to get 2 others.
2 others, okay.
Yeah. Okay. So the benefit of having an institutional grade custodial setup is you are not exposed to centralized exchanges and the hacks of the issues that FTX and Celsius and Voyager went through. You're also not, set up on a hot wallet, or you're not set up on for instance, a personal hard wallet. Okay, so all these things are critical in terms of making sure your assets are safe.
So the big canary in the coal mine, FTX, happens, right? Money gets locked up. It looks like a lot of that money will come back over time, delayed. Whether you'll get the capital gain or not is, I don't think it's been clarified. How does JellyC, confirm to investors that their money is not sitting on exchanges?
Yeah, so each month we produce reports and we show, our overall custody setup. Okay, so we'll report exactly where we have our digital assets. In that, you can see that we only have a small percentage, for instance, for trading purposes, might be on the centralised exchanges. I guess an important distinction here is we have a trustee set up in Australia. So the trustee holds a AFSL licence. The trustee also has to sign off on every single transaction that goes through. So there is an additional layer of security in that the trustee signs one of those signatures, and then you have for instance, you have a representative within JellyC that will also sign, just sign those transactions. Why this is important is because let's look at the FTX example. On the weekend, I think it was the Sunday, CZ came out and said FTT token is worthless, has no utility, and it collapsed. Now, as soon as that happened, we had money on FTX at that point, but as soon as that comment came out, we were able to contact the trustee. We were able to move our money off FTX, our digital coins off FTX, and put it in safe custody. Okay, so we had a small amount sitting on FTX for trading purposes.
24/7, clearly an advantage, but could be a disadvantage in instances like that.
If you're set up in Australia and you are using a trustee, most trustees will only operate in business hours, 9 to 5 from Monday to Friday. You have to have a trustee which is willing to go 24/7 in line with the risks, that are prevalent in the industry. So the whole reason for having a trustee, which is segregated from an investment management business, is so that the assets are more secure. But if you have a trustee which is only operating during business hours from Monday to Friday, then you are seriously at risk on the weekends if you cannot move your cryptocurrency.
And by the sounds of it, potentially trustee is one of the 3 signatories to move the money. So it's
there has to be an
that you
alignment.
have access to it. Right?
That's right. There has to be an alignment there between either you need to pay more money to that trustee to be accessible 24/7, or there has to be some sort of dotted line.
Yeah, interesting. Well, it seems like JellyC's got this sort of, obviously the exposure to the, hopefully upside volatility of digital assets, but probably much more importantly, around the security and the safe custody of people's assets, which I think is really important.
Yeah, I think you have to secure the assets first. Then you have to be clearly you need to be in the space where you're on top of everything and you're allocating to the best plays in the market, and hopefully that's what we're doing.
Yeah, interesting. So Drew, chairman, probably the most chairman positions across the whole digital space in Australia as far as we can calculate. You've got a fair bit going on. Any little snippets into sort of what you're working on across the space?
Oh, look, as you know, Ash, I from my time at NAB, I just see the need for an Aussie dollar stable coin. So we're working pretty hard at getting that up and going. We're actually not too far for a launch on that. So maybe the next podcast we can discuss that a little bit once we've nailed down our last regulatory challenge. But I believe that stable coins will become the only way that you move money around the world. If you look at right now, stable coins are pretty much 98% US dollars. and turn over about $50 or $60 billion a day. If you look at the global foreign exchange market, $7.5 trillion a day of turnover. So that's 150 times bigger than the stablecoin market. And if you look at the stablecoin market is now, as I mentioned, 98, 99% US dollars. I think over time it will resemble what fiat turnover in the global foreign exchange market looks like. Maybe that's a 2, 3, 4 year path, but that means Aussie dollars will start to turn over that represents their footprint in the global foreign exchange market, an Aussie dollar stablecoin, and the Aussie dollar is the 5th most transacted currency in the world. On any given day, it's 2 at 5% of that global $7.5 trillion of turnover. So I think we've got a need for an Aussie dollar stablecoin. And the Reserve Bank, when they did their project on a CBDC, said that they're a number of years away, but they pointed out that a well-managed, prudentially supervised organisation could have all the benefits of a CBDC. So, that's what we're driving on, an Aussie dollar stablecoin, which will add lubricant, add liquidity to the digital asset market space, particularly in Australia. But I think it'll happen globally. And we've seen legislation in Singapore, Hong Kong, Tokyo, Europe, Middle East. So I think that will only increase the number of currencies that have trade as stablecoins as opposed to traditional fiat.
Did I read somewhere that it's quite an attractive business model as well?
I think it's a very attractive business model, but there's some massive inefficiencies. I hate this merchant service charge. It takes you 12 months to get 4.35% on your money at a bank. 12 months. Yet every time you tap your card, someone wants to take 2.5% off you. That's half a year's income. Put it on Solana, Cardano, or any of these currencies. It's 1/100 of a cent to do a transaction, not 2%.
Yeah, I mean, you think we're trying to evolve, it makes a lot of sense. The other thing I think people don't realise is anytime anything's tokenised, a real-world asset, anything, transacting that or paying for that needs a stablecoin.
Yes, and then the transaction happens at exactly the same time. Now, you think about now, if I...
Let's say I bought an old Aston Martin off you.
That would never happen because it's not for sale. So you would then, I would sign you the car, I would sign you the registration papers, and then I would hope that the check you give me when I go, or you post the money in the bank, I hope that it gets there. If you're swapping a stablecoin for a digital asset, you cannot have only one of those things happen. Both have to happen at the same time, or the transaction fails. So neither side is at risk. You can't lose the asset that you're selling on the hope that someone credits your bank account with the fiat cash.
So value exchange instantaneously.
And the transaction only progresses through the smart contract if both sides happen.
Yeah, yeah.
So
if you don't have that, no one's got the liability.
No one's, but you haven't lost the cash. If you don't get the asset, you haven't paid the cash. And if if you're on the other side of the transaction, you haven't transferred the asset until you get the cash. So the whole clearing and settlement problem goes away. It's instant.
So just to qualify on the Aston Martin example, we are talking about the deed, which you might get from the registry at the moment. That deed would be digitized. Okay, and the transaction, when you pay, for instance, in Aussie stablecoin, that goes at the same time, so autonomically settled, real time. So the digital deed goes to one wallet, and for instance, the Aussie dollar comes back to the other wallet. Okay, so that all happens real time. And that can only happen, for instance, when we have digital registries. And to have digital registries, we need to have legislation, regulation in place. So once that all happens, it's going to light up.
Absolutely.
The space will light up.
Yeah, I mean, I hate to think of the mismanagement, the losses on that T+1, T+2 settlement across a lot of asset classes, and it'll basically wipe all of that out and value transaction at the same time.
I'll give you a real-time example. My foreign exchange days at Deutsche Bank, we transferred a whole lot of Swiss francs to Crossair in 2005. You can Google the date that they went bankrupt, on the hope that they would send us US dollars back when the US banks opened later in the day. Their administrator comes in and says, stop all the books. We'd sent them 30 million Swiss francs. We were expecting 30 and a bit million US dollars to come back when the US banks opened. Administrator goes in, you don't get that $30 million. It's locked up in the whole liquidation process. It's called Hashtag risk, but stable coins take that away, that whole Hashtag risk of, because right now, if you send Aussie dollars, we're the first system that opens, right? So if you want to pay for something overseas or do foreign exchange, you send your Aussie dollars out while the banks open. Banks in the UK don't open until we've shut, 5 p.m. Banks in the US don't open until midnight. So you're at risk for that period whenever you do a foreign exchange transaction today.
And this has to be a catalyst for the institutions to come to avoid that 12 hours of liability that they don't know.
Correct. It has. This is why I just think it's just a timing thing. It has to happen.
Great. Well said to both of you. There's obviously a few more podcasts in this. Critter, it sounds like JellyC's got the finger on the pulse of risk management, and in reality, securing investors' assets first, and then allowing them to get exposure into multiple avenues of the digital asset space.
Coops, we're very excited about the future, and we're looking forward to all the funds performing well.
Excellent. And Drew, sounds like you'll be busy for the next, really wrangling the, traditional finance world over and setting up the stablecoin in a regulated and, a proper fashion.
Absolutely. Looking forward to it. We are at a pivotal time for traditional finance over the next 1, 2, 3, 4 years. It's going to be a load of fun.
Great. Thanks again, gentlemen.
Thank
you for joining into the podcast, the JellyC podcast, Unblocking the Chain. We'll be back in another couple of weeks, so be sure to subscribe, rate and review the show, and we'll come back to you shortly. Thanks very much.
You beauty.